let's continue on with accounting principles. This is the second video. Here's our accounting equation once again, but we're going to be looking at some more transactions now. I'm just going to go over a few transactions. The textbook does a fantastic job at going over transactions and explaining to them how they're done. But I just wanted to go over it one more time to make sure that you're really understanding this. So assets equal, so the other side of the equation, how do we get these assets? Either by borrowing money, meaning we owe somebody, that's a liability, or through equity, the owner's claim in the business. In equity, we have broken down between capital, withdrawals, revenues, and expenses. Now, I've already written on the board some examples of assets. There are hundreds of assets, thousands, but I just wrote down three: cash, supplies, equipment. Liabilities, I only have one liability, but there could be more. Accounts payable just means that we bought something on credit. We bought something, but we haven't paid the cash yet, so there's a liability. At some point, we will pay that off, and we'll go over a transaction that shows that. So let's say we're starting our brand new pizza business, and to start it off, let's say that we as the owners have $20,000 we want to contribute to the business to get it started. So we put $20,000 in the checking account, so there's $20,000. Now, how did we get that? Is that a liability? Hopefully you recognize that. That's actually part of the capital. That's part of our capital account. So if this is your money, if this is you putting it in the business, now you have $20,000 claim to the business. Now this isn't really dollar amounts, it's just $20,000 that you have claim to because the cash is over here. See? The equation is in balance. We've got our cash, and then we've got how much you have claim to in this business, $20,000. Now let's say you buy $10,000 of supplies. Okay, so if we need some different types of supplies for our business, we just purchased $10,000. I'm going to put that a little bit lower so that we can see it better. So we've got $10,000 in supplies. Now how did we get that? Well, the problem, your homework problem, would have to tell you, or in the textbook it'd have to tell you. You don't know, just know how you got the supplies. But in this case, let's say that we got the supplies because we set up a credit account with the supply company. So let's say that we now have then an account payable, meaning we owe somebody the $10,000 for those supplies. So now look, our assets total $30,000, and then on this side of the equation, our liabilities plus our equity total $30,000. You see, everything has to balance. If your transaction doesn't balance, you have not done it right. All right, so you need to be very careful looking at every single transaction. Let's say that you pay off part of the supplies. So you get a bill and they say you owe right now $4,000. Okay, well what would happen is cash would go down $4,000, okay? And then what happens to our payable? Well, we paid off $4,000. So we don't owe $10,000 anymore, we only owe $6,000. So you can see here we have 30 minus 4, so we've got 26,000 over here. And over here we've got 6,000 plus 20, 26,000 on this side. Because our payable is no longer 10,000, when you combine these two, it's only 6,000 now. Okay? Let's say we sold $1,000 worth of pizzas. Okay? A big company came in, they're having a big party, they bought $1,000 worth of pizzas, and they paid us cash. So that would increase our cash here. And now, what on this side do we have to increase? Okay? Hopefully you recognize that that's a sale, that's revenue. So that increases the profit in our company. So over here under revenue, we would have $1,000. Now notice that revenue is part of equity, okay? Because think about it, this is your business. It's your business. So if you have sales, whose sales ultimately are they? They're yours. They're your sales. So this $1,000 really belongs to you. So in reality, your capital account eventually is going to be $21,000. But right now we're just going to track it separately because we want to know, well, how much sales did we have? What were our total sales amount? Well, so far it's $1,000. Okay? Let's say that we paid our employee $200. Okay? We pay our employee $200. That would decrease expense and it would decrease our cash. So we'd have $200 in expense, and right here we'd have a decrease of $200 in cash. Okay? Now notice, every time that we do our transactions, things balance. Everything balances out. Okay? So this is just a quick example of just certain transactions. Once again, the textbook goes over lots of different types of transactions. you should probably be thinking of different transactions in your brain and wondering, well, how are they going to fit on our accounting equation? Okay? Just try and think about some on your own. And make sure you're going over the textbook and going over all those different transactions, because those transactions are going to be used throughout the semester. All right? Good luck with this part, and there'll still be another video dealing with the financial statements in Chapter 1.